Hey guys, I'm just jumping in here for a minute. We just finished this interview, and there's some incredible things that Eric said that you need to do by the end of the year. So make sure that you finish this video and watch right to the very end. Talk to you soon. Hey everybody, it's Ken here. So I've been asked repeatedly, we get texts, DMs, emails from people asking what exactly is going to happen with this new presidency. What does the Biden presidency mean for our tax bill? So what I did was I called up my buddy Eric here right over my shoulder. Hey, Eric.
Hey, Ken. Thanks for having me.
Yeah. So as you guys might know, Eric does all the tax returns for our firm. We do well over 100 tax returns. I'm on the phone with him every single week. We meet in person once a quarter. We talk detailed a lot because taxes are a big part of real estate, and they can be used for an advantage, or if you don't know, they can seriously be a massive disadvantage. And so I went to Eric. Eric, why don't you tell him a little bit about your experience and what you bring to the table? And you immediately jumped on this call, said, "Okay, I've got some ideas, some people can do this year." And so let's jump right in a little bit on your background.
Absolutely. Yeah. And thanks for having me again, Ken. I always love our little chats. So anytime. So I specialize in real estate taxation. I've been professional in the field for about 10 years now. And this is kind of my bread and butter, dealing with real estate issues. And I also do a little bit of investing on the side in real estate. So I kind of know the ins and outs. And what I always tell people is knowing the taxes is great, but at the end of the day, you also have to consider what's the best financial move. So it's always trying to find the balance between the two is oftentimes the challenge. So, and yeah, there are a lot of great planning opportunities as we come into year end. The challenge that we always have when we get a new administration is that we hear all about what they're thinking, what their ideas are, and we get this big picture, and then some specific little tidbits, and then what you actually see may not develop, or we probably won't see a change definitely for 2020, and we're probably not going to have anything for 2021 potentially. A lot of times it takes about a year to really get things finalized, as we saw with Trump's plan back in they took effect in 2018. So we do have a little bit of time to plan, but obviously the challenge without knowing the law is that we don't know exactly what to do. So there is some guessing, but overall it looks like the general idea under Biden's plan is increasing tax rates to the higher income individuals, and he's defining that as those making over 400,000, and then in addition to that, providing some tax credits or other tax write-offs to those that are under 400,000, which is basically a complete flip-flop from what Trump's idea of what we should do with our tax laws, because his idea was essentially giving more breaks to the wealthy, which would then feed into and provide jobs for the middle class and the rest of America.
Right. I read that we're looking at somewhere right around $3.5 trillion in tax, and it's on corporation and individuals earning over 400,000, right? Isn't that kind of what he said publicly so far?
Yeah, that's basically the big picture gist of it, and how he's trying to accomplish that is raising corporate tax rates from currently they're 21%, and he wants to up them to 28 is what he's talking about. And then on the individual side, there's really a lot of changes he's talking about, but one of them is increasing the marginal tax rate. Right now it's 37% on the highest income and then our highest wage earners, and he wants to increase it up to 39.6. And then he also wants to add an additional Social Security tax for those making over 400,000. So, which will be kind of interesting because currently everyone pays, or at least the employer and the employee together pay 12.4% on up to about 137,000 of wages, and then above that, that 12.4 goes away. He wants to basically, once you start getting over 400, he wants to start adding that 12.4% back. So they'll end up with this little gap where if you're in between there, you're not subject to the additional tax. And then once you get above it, you're paying it on your uppermost income and then your lowermost income, but not the middle. So it's kind of an interesting proposal, I guess.
Yeah, yeah. And so, what are some things that people can do, to try to, as you know, when we tax plan, we're very strategic on what we can do legally, and of course, that's going to happen again. And so but there are some things people can do to, to mitigate some of their tax and even potentially use credit, because I think that a lot of his tax plan has these credits, which are actually good, right? So everybody kind of focuses on the increases of taxes, but there's also tax credits that are going to be very, very good.
Yeah, it's so there's kind of two parts there that you're bringing up. So I'll tackle maybe the credits first. So some of the credits are, for the most part, it's for people making less than 400,000. So it's good news for anyone that's in that bracket. And then it's also good for new home buyers, because I think one of the credits is he's proposing a $15,000 first time home buyer credit, which I don't know if anyone remembers, but back in sometime around 2010, for a couple of years, there was a home buyer credit. I think it was like 8,000. But that was also when the housing market was having a little more trouble. Today, I don't know that we're necessarily having trouble. So it could, the effect that has on the affordability, who knows? But that's one credit where if you're thinking about purchasing a home, maybe it's something you wait on, depending on your situation. And then there's other credits. He wants to expand the child tax credit. So that's the one where if you have children, you can get up to $2,000 per child. He's talking about increasing that to about $3,000 per child. So a pretty significant increase. And then, there's some other miscellaneous credits, but I think those are the big ones. As far as planning for the changes that are coming, it's really almost backwards to traditional logic, because generally what you're trying to do is defer your taxes, right? We have all these provisions in the tax law, like 1031 exchanges, where the whole concept is, I don't want to recognize my gain now when I sell. I'd rather roll that gain into another investment and recognize it later, because, obviously time value of money is very important. It allows you to buy bigger things and generate bigger cash flow. So it's a great wealth building idea. Now, with knowing that there's a very high probability that taxes will increase across the board, and that is not only on your wage income, but it's also on potentially capital gains income. We've had historically low capital gains rates for the last 20, 30 years. And most people are paying 15%, but Biden's proposal is anyone over with income over $1 million, they would be paying at their highest ordinary income rate, which under his plan is almost 40%. And then you tack on state taxes and everything else. I mean, you're up to 50% of your gain is just gone. So it may be a time where you actually think about accelerating some of those capital gains if you're above those thresholds.
So let's talk about that real quick.
Yeah.
So right now, there's a lot of people that are I say that they're house rich and cash poor. In other words, we've had this really good run up in real estate over the last 10 years. And so they have a lot of equity, but they could be dealing with some of these COVID related issues. They could be even in forbearance. There's all kinds of things. And so if they if they bought their house at 200 and it's worth 350 and they exit, then that capital gain would be the difference between, from their basis, the 200 to the 350, right? So they would have a capital gain on that 150,000, right?
Right. And that, brings up even another good point. So right now, if it's your personal home, you potentially get an exclusion. So you don't actually have to recognize a gain if you've lived in that house for at least 2 out of the last 5 years. And that was actually on, the chopping block back when Trump was going over his plan and they decided to keep it. But although it hasn't been talked about yet in Biden's plan, that is something that may come up again on the chopping block where you can't exclude your personal residence from income. We don't know, but yeah, if that's the case, you might want to. Right.
That's something to watch, because then, as you said, these tax laws sometimes take a while to come out. I mean, it could be a couple of years. It might not even happen, but this is why you need to take a look at that, because I think I personally believe, and I've said this on a bunch of videos, that I think people are going to scoop some of that equity and, relocate. Maybe they haven't been working. They're going to, maybe they pay off some mortgage forbearance and, and they collect their chips and they kind of restart somewhere. And I do believe that we are going to see that next year as a lot of these CARES Act things, kind of wrap up and hopefully things go back to, semi-normal, and so I think people are going to start to recognize that maybe their incomes are way off or they have to move. Maybe they're moving somewhere for a job. They're going to sell their homes and move somewhere else. This is going to be it's going to be a lot of income that's going to hit, I think, next year and the year after, and so this capital gain issue is a big issue because it's not necessarily earned income, right?
Right, exactly. Which is one of the reasons, I think it's so far been justified that it's taxed at this preferential rate. The income that is taxed at that rate is generally the hardest income to really predict or to obtain, right? I mean, because most of the time it requires an asset to increase in value from when you purchase it, or for you to buy it below market somehow. So it's harder than, say, a wage where, when you go and you get that job offer, for the most part, taking all extraordinary circumstances out, that if someone says, hey, your wage is 50,000, well, you're going to get 50,000 that year, right? Unlike a capital gain. And so part of the theory behind taxing at that lower rate is there's more risk in obtaining that gain. So yeah, it'll be interesting to see if that actually changes. And it's kind of one of those things where historically we're on this kind of low dip for taxes for the wealthy and even middle income. And part of the reason is that capital gain. And so it's likely just a matter of time, whether it's Biden or it's someone later down the road. I mean, eventually it's going to turn around.
Right. Well,
sustain it.
The other thing from a real estate perspective is Trump rolled out these opportunity zones. As you know, they're all over the country. And if you don't know what they are, guys, just Google opportunity zones. And it's pretty cool. You can go in and see exactly what areas in your town or in nearby towns. And basically what that means is that you could take capital gains and roll them into these opportunity zones. And that money would then be used, of course, to redevelop areas that need to be redeveloped as determined by these zones. And so that's all going to potentially be on the block as well, right? Especially if we have a big capital gain tax.
Right. Yeah, I think so. The opportunity zones, limited window for that. Even if it doesn't change, you have until 2026. It sounds like it's a ways away, but it'll be here before we know it. And, ever since that law was passed, there's been people against it. And especially because a lot of the areas that were designated, because there was a lot of flexibility. So the state governors were allowed to elect these zones, and they had to meet certain poverty levels, but those poverty levels were from 7 years before. And they were allowed to include a certain amount that didn't necessarily meet that poverty threshold, but just because it was next to one that did. So you see a lot of areas, and I see it here in Arizona too, both in Phoenix and Tucson, where both downtowns are part of the opportunity zones, but they're huge they're not necessarily struggling. There's a lot of money pouring into them, and that's all over the country. So there's a huge opportunity to buy potentially a good asset. It's not necessarily a C-class asset.
Right, right. And I have a buddy that they actually specialize in this, and they've been putting together these $100 million opportunity zone funds. And they've been targeting business owners that have been selling, for 10, 20, 30, 40, 50, $100 million. And then they have these big cap gains in their businesses. And so they've been rolling these into those opportunity zone funds. And then those have been invested into those areas. But again, that's a deferral, right? That's essentially it, like you said earlier, it kind of kicks the can down the road.
Yeah, I could, talk about the opportunity zones for a long time, but the first part of it is essentially a deferral, whatever gain you're rolling into it. But the huge benefit that really you want to consider it for is that whatever you invest in, if you hold that investment for at least 10 years, then you don't pick up any of the gain on it ever. So in other words, you sell, say, your personal residence, and if you have a capital gain there, let's say it's 100,000, and you put your 100,000 capital gain into an opportunity zone fund, and then in 10 years, let's say it's worth whatever it is, $500,000. Well, you've got 400,000 of appreciation in that investment that'll never be picked up. And so that's the big piece. But that 100,000 that you originally invested, that's a deferral. You'll pay that tax in 2026, but that additional increase is really what you want to consider and
Right.
want to go after.
Yeah, so you really got to keep your eyes on this one, guys, because traditionally, when one president comes in, they usually unwind typically what another president does. And so that certainly could be something that you're going to want to keep your eye on. Another one is, you briefly mentioned, was that 1031 exchange. Now, this comes up every time, and we've done a lot of 1031 exchanges with Eric and, through Eric and with his counsel. And essentially, you could sell a property and roll all of that into another property and defer, again, just kicking the can down the road, defer that gain and not have to pay tax, right? Essentially.
Yeah, right. That's pretty much exactly right. And it's kind of interesting. Like you said, it always comes up. I think a lot of real estate related provisions come up all the time. But luckily for the real estate industry, there's a lot of strong lobbying and good reason behind it. I mean, real estate is a very capital intensive business, whether it's your money or it's the bank's money or it's your friend's money, it's someone's money, right? That's purchasing that asset. And so a lot of times what these tax policies are all about incentivizing certain actions, right? So if you take away 1031 exchanges, you're potentially hurting the real estate market, which potentially may hurt other businesses. So, I'm sure it'll continue to come up as far as actually going away. Until we get closer to that happening, I wouldn't be too worried about that one specifically, but there's certainly a lot of other changes that are going to pick up that.
So let's talk about the step up basis, because I know that's kind of, first, would you explain it? And I know that's something that he specifically has talked about. And this is a big one because we have all these aging baby boomers, like my mom, her house, I have her, we still own her house. And, if the step up basis goes down, then there's really no reason to hold her house. You know what I mean? And so there's going to be decisions made if this piece is gone.
Right. Yeah. I think you're referring to essentially the estate tax. So there's the reason this could also be such a huge detriment to people is that it's almost like a double tax, because if you're above the estate exemptions, which Biden's talking about lowering, bringing them back down to potentially half what they are now. So you get taxed on your gross value that you pass on if you're above these exemptions. So let's just, for simplicity, take a house, which was your example. If you pass away and your children inherit that, then your estate pays tax on whatever the value of it is, right? So if it's 500,000, it pays tax on 500,000, and a high tax rate too. The estate tax is generally pretty progressive, and so now, because you're paying tax on that gross value when it passes to your heirs, you get that step up that you're referring to. So if you had paid, 100,000 and now it's worth 500, your basis to your heirs is now 500. So they don't pay tax. They don't pay a capital gains tax on that difference. If they sold it immediately after they inherited that asset, they'd have no capital gains tax to pay. They sell it for 500,000. Their basis 500, zero gain. So what Biden is proposing is taking away that step up. So now what would potentially happen is you get taxed on the 500,000 gross when it passes to the heirs, and then the heirs, if they sold it immediately, would then get taxed on that gain, potentially 400 in this example. So that's where that double tax concept comes from. So if you are above those estate exemptions and looking at them as what they may be in the coming years, half of what they are now, then you may want to do some gifting now to get those away from your estate and potentially shield some of those assets from the estate tax. So I think we're going to see a lot of gifting before the end of this year. And if we see more concrete plans, likely we'll see some going into 2021 as well.
Oh, we have a gifting meeting on Friday.
That's right. That's
Literally, it says on my calendar, gifting meeting with Eric. And here we are in mid-November, to maybe make some moves by the end of the year for this exact reason. Essentially, guys, as my mom aged and she had a home, the question was, do we sell it and we pay tax on it now, or do we wait? And there's this thing called Step Up where the lawyer said, listen, you're better off to wait, because when she passes, which is a horrible thing to say, but that is one thing that's certain, death and taxes, Eric.
Right. Yeah.
So, at that point it passes to, the heirs with no tax. Now that's on the chopping block. And now all of a sudden we're looking at a pretty big number, if that's gone. So this step up base is a big thing, especially because a lot of people made a lot of money in these last 10 years. And there's a lot of wealth, and a lot of people have very big estates. So this is a big target, I think, for the next administration.
Right. Yeah. I think there's going to be big changes. We'll see if that one passes, but one that I think, we're probably a little more sure about is that lowering of the exemption.
Yeah. I would agree with that. And look, can we talk just real briefly about this qualified business income, the elimination of the 20%, because I know that's also on the chopping block. A lot of real estate professionals have LLCs and corporations that they keep their assets in. How will that affect them?
That's a good question. So right now, this is one of those things where he's talking about having that 400,000 cutoff. So Trump, started this 20% deduction, and the reason for it was they had lowered the corporate tax rate down to 21%. It used to be a highest rate of 35, I believe. And so, the rest of America, most of America's small businesses, which are not C corporations, they're pass-through entities, generally LLCs, as you mentioned, which are taxed as partnerships, or other types of entities that aren't taxed at the corporate rates. And so to kind of level the playing field, since we're bringing down the corporate rate, the idea was, well, let's bring down the tax rate for these other small businesses. And so they did that by basically giving this deduction. So if you made 100,000, you had income that qualified, you'd get a 20,000 deduction. So in effect, you're only getting taxed on 80% of your income. And, that in effect lowered the rate, your effective rate that you're paying. And so now Biden wants to, right now he's talking about taking it away for those making over 400. So if you're under that, then you're probably okay. If you're over that, there's, a decent chance that may go away. And so now you may be considering, depending on what type of assets you have and everything, you might want to try and pick up more ordinary income this year too. So cost segregation studies are a huge planning opportunity for real estate investors where you're trying to take and accelerate your depreciation deductions now. Well, you may want to hold off on doing that cost seg this year, and pay and get that 20% deduction, and then in a future year maybe do a cost seg to get you below that 400,000 mark if you're above it. So that's one potential planning idea when we're talking.
So for those of you who are confused, the way this works is every property that we have, you can do a cost segregation. In other words, you can actually use a depreciation. It's a type of depreciation, right, Eric? And you basically get a deduction. It's not an operating expense, but it's a deduction that you can use to offset any income.
Right, exactly. You basically, when you purchase an asset, you take this deduction over time. That's essentially what depreciation is. So the cost seg basically says, you identify specific assets within that. So the building you're looking at, instead of looking at it and depreciating the whole thing over a useful life, you're breaking out components that may not last as long. And so when you break those out in the study, you get this immediate deduction to bring your income down. So you're just accelerating when you can take those deductions is essentially what the cost seg study, and you can time it. So you don't have to do it the year you purchase it. You don't have to do it the year you sell it. You can do it anywhere in between. And so it gives you a lot of flexibility. And so it's a good timing tool when you,
so pay attention to those cost segregation studies, because so the way the multifamily depreciation works is 27 and a half years. You have to take the land out and you can depreciate that 27 and a half years. And the bonus deduction or the cost segregation of the components could be your appliances, your carpet, all the things inside of there can be done is it a 5-year?
Right. Yeah. Most of it is 5-year property.
Yeah. And so anyway, you want to get a study for this, but essentially you can accelerate these deductions, and then that will lower this $400,000 this bar that he's looking at for 400, because you could be above it, but with these cost segregations and these depreciation techniques, you can actually lower your basis, right, or your income.
Right, lower your income for that year so you could qualify and get that extra deduction. So it's almost like a double benefit potentially, depending on how the law actually ends up. If it's anything like Trump's plan, where we thought, he kept saying simplify, and then it actually got more complex. So it just kind of teaches you, take everything with a little bit of grain of salt when you see some of these plans.
Right. So before we wrap up, what are some things that people can do between now and the end of the year? It's just basically 6 weeks. So what are some things that they should be doing or looking at doing to get prepared for next year?
Well, I think we mentioned a lot of the big ones, but there's some others. So just to kind of bring it together, I'd say consider recognizing some of the capital gains if you're above the 400,000 for sure. Consider holding off if you're going to do a cost seg study, or if you have other depreciation items that you might be purchasing. If there's big purchases, cars or other assets, depending on how much time you can wait, maybe wait on some of those. They can offset higher rate income later. Maybe think about potentially converting some of your income. If you're a high wage earner right now, maybe you can somehow convert some of your income from, instead of W-2 income, if you can convert that to another type of income, so you're not subject to additional Social Security taxes. Don't do anything now before year end, but definitely consider it, because those things take time. Maybe gifting now is something you might want to consider if you're going to be above potential exemptions that we'll have. If you're considering buying a home, maybe hold off until you might get some additional credits later that will help you. And then consider planning, this is not necessarily before the end of the year, but the more that the rates increase on higher income, the more beneficial it is to do certain, high lucrative retirement plans that you may not otherwise be doing. You're giving up a little flexibility sometimes, contributing to retirement plans, but if the tax rate is high enough, sometimes those costs become more worthwhile. So I think those are kind of the major things to at least start thinking of. The biggest thing is just focusing on those capital gains. Otherwise, hope that we get, we've got 2021 to kind of plan for before a lot of these changes are likely to come in 2022. So be aware and just start getting these things on your mind now.
Folks, I don't know if you realize, but that was some gold there from a guy that's $1,000 an hour. Nice job, Eric. Wow. And if you guys are a little confused about what he just said, so am I. So don't worry about it, because I have to dig deep on all this stuff as well. So, don't feel like you're sitting out here trying to figure out exactly what he said. I recognize some of it. I didn't recognize the rest. I'm going to catch up with you Friday and ask. I'm going to watch this video and have more questions for you on Friday. But Eric, thank you. This is gold. These are great things that people can do before the end of the year. I always appreciate your time, and I'll see you in a couple days.
Absolutely. Thanks again, Ken.
All right. Cheers, man. See ya.